Alright guys, welcome back on my channel once again. It's Fabio Mezzogori here and I hope you are having a great day so far. So in today's video, I'm gonna be giving you the exact portfolio ratio that you need to have, not only for having a, let's say, a return year on year of about 10% in the last 72 years, which is the back testing that I've done until 72 years ago because I couldn't go farther, but also which is gonna be completely recession proof, alright? In order for you to have a recession-proof portfolio, regardless of what's happening in the economy, you need to know only three things, okay? Let's dive into these three things straight away. The first thing you need to know for a recession-proof portfolio is diversification. Diversification. All right? Portfolio diversification. Everybody right? Yeah. So let me clarify diversification because I spoke with a lot of people and it seems that there is a lot of misconception in regards to it. Let's consider, for example, the S&P 500. Okay? The S&P 500 is a composite of 505 different stocks which are divided in 11 different sectors. Okay? This blue marker is not working. Let me take the black one. S&P 500, there are 11 different sectors, 505 companies across 11 different sectors. So you can think that if you invest, let's say, in different sectors, let's say a bunch of stocks here and there across 11 sectors, across some sectors, you are diversified. Well, think again. Because if you have your money tied up within this sector right here, if the market gonna take a whack as it's currently doing in the last 3 weeks, you will be, quite in the red side, I would say, okay? Because if you have money tied up within some company, within some stocks company, or you have your money tied up only within the S&P 500, is the same exactly thing. If you buy a share of the S&P 500, actually, you are more diversified than going over some stocks within the sector, okay? So chances are for you that if you now have bought, let's say, the S&P 500, you are down about 15%. If you have bought some stocks within the sector, you're down much farther than that, okay? Because just by the time I'm speaking, or actually yesterday, some companies within the oil space were down 50%, 50, okay? With that being said, now that you know that if you have money tied up in some companies or only in the S&P 500, you're not diversified by all means, let me tell you also this. Asset allocation, okay? If you want to be diversified, you don't have to go only across sectors, but you have to go through different allocation, okay? What I mean by that, now there are several different assets allocation. I'm gonna be giving you right now the one that you need to have in your portfolio in order to be recession proof, okay? Then if you want, to know more about this stuff, I'm launching at the moment a course, so it's gonna be the first link in the description down below. Just click on it and join the waiting list, okay, if you want to know more about this stuff. So asset allocation, which asset allocation you need to have in your portfolio in order for it to be recession proof? You need to have, of course, stocks, okay? Then it's up to you if you want to have the S&P 500 or if you're a fan of stock picking, you can go through whatever company you want. All right, so you've got stocks, you've got bonds, you've got commodities, and then eventually you've got gold. Okay? Now, I know what you're thinking. Isn't it gold a commodities? Absolutely yes. Gold is a commodities. However, later on in the video, I'm going to be telling you why I have separated the two. So let's consider stocks, bond, commodities, and gold. Now, with that being said, and with the knowledge that you just gained in about, 5 minutes or whatever, this is a diversification because you're not only going through, let's say, different sectors, but you are going through different asset classes. This is considered a diversification, this is not considered a diversification by all means, because all of those sectors here are within the S&P 500, which is an index stocks. Okay, so this is not a diversification. This is a diversification. Okay? With that being said, now you know what diversification is. Let me go over the second thing that you need to know, which is market correlation. Boom. Correlation or correlations. Okay? Market correlations. Let's start from the beginning, because some of you could be more, let's say, informed than others. So let me start from the very beginning. What you need to know about correlation. You need to know that there are positive slash negative correlation. Okay, positive and negative. What I mean by that? Positive correlation, I mean when two markets moves in the same direction, okay? Regardless the markets now, I'm just giving you a theory. If two markets are moving in the same direction, they are, from the market terminology, they are positive correlated with each other, all right? When two markets, instead, as you may guess already, when two markets moves in the opposite direction, so one goes up and the other one goes down, you have a negative correlation, okay? So positive correlation, two markets move the same way. Negative correlation, two markets moves in the opposite way or roughly the opposite way. Now you know also this. Let me add you another thing on top of that, which is risk on / risk off environment. Let me put it. Environment. Risk on, risk off environment. What are they? Think about a hedge fund manager. If you are a hedge fund manager, and well, let's say this, you have $1 billion, for example, under management. It means that people like yourself, like myself, like anybody, puts money into this hedge fund, okay, because we want our money to work for us. We want to have hopefully a positive cash flow from our investments, okay? With that being said, if you are a hedge fund manager, it means that about 90 to roughly 95% of the money that comes from investors like yourself, myself, or anybody must be invested at all time. Okay, regardless the economy, regardless bad period, good period, economy is flourishing, economy is crashing, whatever might happen in the world, 90 to 95% of your at all time you've got to have money invested in something. Why I'm telling you this? This is crucial, so pay attention to it. When you are in a risk-on environment, as you might guess from the words itself, it means that people are more keen to invest their money, to risk their money. So money will be moved into riskier assets, okay? Riskier assets. Let's use this example right here. So I'll stay only right here now because this is a YouTube channel, so I don't want to go too deep. Stocks is considered a riskier asset, or at least riskier compared to bonds, for example. So if the economy is flourishing, as it was happening until 2 weeks ago or something, you need to know that as a hedge fund manager, put money into riskier assets, aka stocks, for example. Okay, so you see, if you can take the S&P 500 charts, you can go on any platform, and let's go from 2016 to 2 weeks ago. You will see a chart that looks like this. Okay, you got ups and downs, some bumps here and there, but overall, market is going straight up. Okay. When stocks goes up, you are overall in a risk-on environment. Okay, so what happened until 2 weeks ago? Where we were until 2 weeks ago? Right here, risk-on environment. Regardless what we think about the economy, we don't have to let our thinking, our thoughts, mess up with the market. If the market goes up, it is that you are in a risk-on environment from a market perspective, at least. Not yours, not mine. From a market perspective, you are in a risk-off environment, period. Now, instead, in the last 2 weeks or so, you saw a dramatic shift, I would say, from risk-on to risk-off. This is due to many reasons. There is coronavirus, the crisis between Middle East and Russia in regards to crude oil and all this kind of stuff, the Rocket Man and whatever it might be. In about 2 weeks' time, world changed just like that, and money flows from risk-on to risk-off environment. What is risk-off environment? Think as an hedge fund manager. You have to have your money invested, almost all of them at all time. You have no choice than move your money from riskier asset to less riskier asset, or considered to be safe haven, okay? Safe haven asset, let me take off all this stuff. You have safe haven assets. Okay, you're going to move money from stocks, for example, into safe haven assets. What is a safe haven asset? These could be things like gold, for example, bonds, for example, yen, which is considered a safe haven, Swiss franc, which is considered a safe haven, and on and on and on. Now, for the sake of this video, again, I don't want to go too deep, so let's just consider our portfolio right here, okay? Which, by the way, it's enough for you to have a recession-proof portfolio, okay? If you are an hedge fund manager and the economy is shifting quite dramatically and rather quickly, I would say, you are going to move your money from risk-on, from stocks, into risk-off assets, aka you will see bonds skyrocket, gold skyrocket, while bonds is taking a whack, and so with commodities, gold is skyrocketing along with bonds. If you can have the chance to see these charts right here, they are telling you the truth. Don't believe me. By the way, I'm not a financial advisor. Okay, this is a YouTube channel, and I'm not a financial advisor. If you want to invest your money, make sure to all this stuff, do your due diligence, and use a financial advisor. With that being said, if you have the chance to see stocks chart, bonds, commodities, and gold charts, you will see what I'm telling you. Okay, in the last 2 weeks, there's been a dramatic shift between these asset classes. And why this happening? I deleted. Anyway, for this reason, because hedge fund managers are switching their portfolio from risk-on right bang into risk-off environment. This is why you see this kind of shift, dramatic shift, I would say, in a rather quick period of time. This is the reason. And now you know the same stuff that a hedge fund manager that is managing billions of dollars use, okay? You know all the same stuff. With that being said, let me just delete a little bit of this stuff here. So I hope you are with me here. I'm almost finished. Then, of course, if you have any kind of question, just let me know in the comment down below. I will be more than happy to help you to go through more in details if you are interested. Also, let me know that I'm gonna go over other different videos. Now, by the way, diversification, correlations, okay? You need to know only the last thing in order to have a portfolio completely recession-proof, which is weight. All right? Or whatever you want to pronounce it. Weight. Portfolio weight, I'm talking about, not your weight, portfolio weight. Now, consider back again our, let's put it down here. We've got our recession-proof portfolio. We've got stocks, we've got bonds in it, we've got, commodities, and we've got gold. And by the way, the reason why I separated the two is exactly the same reason I told you before. And let me know in the comment down below if you got this point. Gold is considered a safe haven, and commodities is absolutely not considered a safe haven. if you see the charts of the commodities, overall, they moves with stocks, okay? Stocks and commodities are, generally speaking, a positive correlation, in a positive correlation between each other, okay? Why this? Because if the economy is flourishing, of course, the stock market tends to goes up, and of course, commodities, because the more the companies need to produce, the more products, the more prime materials are used, and the more commodities are used. Actually, is a chain, if you like. So gold has been seen as a safe haven asset. Commodities is not seen as a safe haven asset by all means. Now, with that being said, let me come back where I was before. Okay, this is our recession-proof RP portfolio. Okay. However, if you're going to divide this portfolio in equal part, let's say 25% each, okay, well, this is not a diversification. This is not a diversification as this one. It's absolutely not a diversification. Well, it is, but not for a recession-proof portfolio, okay? To clarify this, why I'm telling you this, because these markets here, 1, 2, 3, 4, and in general all the other markets, they moves with different pace, okay? There are some markets that are more quicker than other, more volatile than other, more, let's say, turtles than other compared to each other. With that being said, why this is if you have only one takeaway from this video, it's gotta be the weight of your portfolio, okay? Forget about the rest, take this one. Why I'm telling you this? Because the lower the asset class you are investing in, or by the way, within the portfolio, okay, the lower the asset class is, the bigger the slice of your portfolio needs to be, okay? And as you can guess, it's gonna be the other way around. The, let's say, more volatile a market is, the smaller your slice of portfolio needs to be, okay? Let's be clear on that. Why I'm telling you that? So let's take that. Well, Giotto. We've got Giotto. With that being said, we now know, or at least let me tell you, bonds, compared to all the others, is considered the turtle, okay? Because bonds tends to move slowly and steady over time, okay? They are not fast, they are not volatile, they're just quiet, they just move, okay? At their own pace, if you like. With that being said, we know now that the slower the market, the bigger is gonna be the slice in our portfolio. So this is our portfolio. With that being said, let's say this being bonds, okay? And later on in the video, now, I mean, don't go too far. I know that you are saying which kind of bonds, which kind of stock, which kind of commodity, which kind of, well, gold is gold, so that's it, that is, by the way. Later on in the video, I'm gonna be giving you everything, all right? So let's stay here with me now. The biggest slice is going to be bonds. Now, we know that stocks, let's say, compared to bonds, are more volatile, okay? So they move quicker, faster than bonds, but they move slower compared to commodities and gold, okay? So with that being said, the second biggest slice in our portfolio after bonds is stocks. There we go. Okay? And finally, the last, let's say, slice of the pie, you're just going to divide it in two, equal part, 50-50, and you're going to split them between commodities, you're going to split these two parts between gold and commodities. Okay? So you've got gold and you've got commodities. With this kind of diversification that I just gave you right now, with this kind of information that I just gave you right now, you will have a portfolio which is completely, absolutely, without a shadow of a doubt, completely diversified, completely correlated in the, not only across asset classes, but also across weight. Okay, because we now know that these asset classes moves differently. who moves faster, who moves slower, who moves more or less, okay? So you now know everything you need to know in order for you to have a portfolio which is completely recession proof. Just to give you an idea about the power of this portfolio, if you like, I have backtested it as far back as I could go, 72 years ago. And the worst period that this portfolio came through was, of course, 2008 credit crunch crisis. When the S&P 500 was that, you can check this information, by the way, are online. Okay, you don't have to believe me if you don't want to. Go online and check it by yourself. The S&P 500 closed down minus 36% over the course of a year. My portfolio, by the way, which is not my portfolio, well, it's my portfolio, but I haven't created. Then later on, I'm going to be giving you every detail. This portfolio right here in 2008, okay, 7, 8, 9, so during the credit crunch, was down 3%. Okay, 36 minus 36, hoping minus 36, compared to a minus 3%. I guarantee you, and I bet you on this, that between 36% and 3%, you would take this one, by any shadow of a doubt. With that being said, even though you're going to reduce at minimum your risk, the return year on year is actually the same. We are talking about between 9 to 10% year on year of positive return, compared to a reduction in drawdown of tenfold. Okay. With that being said, I think that by now you have lots of things that you need to digest. In the next video, I'm gonna be going over the exact ratio that you need to have in order to being properly diversified in regards to asset classes and in regards to the weight of your portfolio. However, in the meantime, if you're interested to learn more about this stuff, again, I'm just scratching the surface here with this stuff, okay? Then eventually, if you want to learn more about this in order to be more knowledgeable, create your own portfolio, be more diversified, know all the correlation, asset allocation, etc., etc., I'm creating at the moment a course right now. So you just need to click in the first link in the description down below to join the waiting list, okay? And I'm gonna be let you know as soon as the course is gonna be ready. For this video is enough. Thanks for watching, and I'll see you in the next one. I hope you enjoyed this video, guys. I put a lot of valuable information here on YouTube that help you to move the needle towards financial freedom or financial independence. So if you'd like me to notify you every time a new video is up, make sure to hit subscribe and turn on notifications so you will not miss any new episode. And also, don't forget to smash that like button for me. Thanks for watching, and I'll see you in the next one.